Life insurance as a tax strategy. First of all, I think anytime that we're talking about any strategy, a one-size-fits-all never works well. But when we do talk about a fundamental aspect of tax strategy, life insurance can play a critical role. So whether it be passing on from a death benefit standpoint in a tax-free environment, should that be needed, working from an estate planning standpoint with handling estate tax potential issues that may be there. But what most people don't realize that's so important from a tax strategy with life insurance is the ability to pull the cash value out while still living if it's properly structured and it is 100% tax-free. So if you review a properly structured life insurance policy, the assets that you put in there will grow cash value. It grows tax-free, just like a Roth would. You can pull the income out of it tax-free, just like a Roth would. The number one difference between the two is there's no age restrictions. You can't access the Roth until you're 59 and a half, and there's no income restrictions on the life insurance side. You can put in as much as you can qualify for. When they're structured properly, a fantastic tool for tax strategy. I think it comes down to the fundamental question of whether or not you believe taxes will be higher in the future. If you do, now is a great time to begin getting assets into a tax-free environment. So let's talk about why that's important. If you are going down the traditional tax-deferred status, meaning you are deferring part of your income in a 401k and you're basically taking that pre-tax. When you go to pull that out, you will be taxed on whatever the income is that you pull out at a later date. We have no idea what tax rates will be at that point in time. A logical thing is if I want to begin taking back control and not be beholden to whatever tax rates may be, then getting a portion of my overall retirement income in a tax-free environment would be critical. Life insurance is a fantastic tool along with other tools, but life insurance is a fantastic tool for that. So when you ask about what age, there really is no age as to good or bad. Obviously, there is a cost aspect of life insurance, but we have, if you're in good health, we have people that are doing it all the way into their 60s and 70s because we are not doing it for the death benefit. The death benefit, in essence, is the wrapper that gives it a tax-free status. And so if I were to go out and say, hey, I want to buy a tremendous amount of death benefit to pass on, of course it would be expensive at 60 or 70. But when I'm minimizing the death benefit down as much as I possibly can within the IRS guidelines and maximizing the amount of cash value that grows inside the policy, of which I can pull as income, age becomes much less important.